In this lecture, we are going to look at prepaid income, sometimes called income received in advance. We receive income in advance for goods or services which will be provided in the future. Under the accruals concept, income is matched to the period it relates to, not the period when cash is received or an invoice is issued. A business might receive cash in advance, or it might issue an invoice in advance, but neither of those actions automatically mean the income has been earned. What matters is when the service or access is actually provided. This ensures profits are not overstated or understated in any accounting period. Typical examples of prepaid income include rent received before a customer uses a building or insurance or service contracts paid up front. Let's separate cash flow from accounting profit. Cash flow records money when it is received. Profit and loss only shows income that has been earned in the period. The balance sheet shows what is still owed as a liability. Prepaid income is a liability because the business has a future obligation. Until that obligation is fulfilled, the amount cannot be treated as earned income. Let's now work through the example. Rent cash £6,000 received from the customer on the 1st of January 2025. This covers the period from the 1st of January to 31st December 2025. So this payment relates to 12 months of rental income. We spread the income evenly over the year. £6,000 divided by 12 months equals £500 per month. In January 2025, the business receives £6,000 and recognises prepaid income in the balance sheet. At this point, bank increases, but income has not yet been fully earned. The rent relates to January through December, not just January. Only the portion relating to January can appear in January's profit and loss. In January, profit and loss shows £500 rental income. Balance sheet shows prepaid income of £5,500. Looking at the ledger entries, bank is debited once for £6,000. Prepaid income is credited initially each month. £500 is transferred from prepaid income to rent income. This reduces the liability and increases income correctly. In February, another £500 is earned. Profit and loss shows £500 rental income. Prepaid income reduces to £5,000. So the liability continues to fall as the service is provided. The same process continues every month. Each month, £500 is recognised in profit and loss. Prepaid income reduces by £500. By matching income to time, the accounts remain accurate. Let's look at the full picture for this rental income. On the 1st of January 2025, the business receives £6,000 in cash. This is shown immediately in the bank account because cash has come in. However, this payment covers the entire year from January to December, not just January. Under the accruals concept, we cannot recognise the full £6,000 as income straight away. Income must be matched to the period it relates to, which in this case is spread evenly over 12 months. So each month, £500 of rental income is earned. That £500 is credited to the profit and loss account every month from January through to December. At the same time, the balance on prepaid income is reduced each month. At the start, prepaid income is £6,000 less £500 because January rent has been earned. By 31st December 2025, the full service has been provided. All £6,000 has now been recognised as rental income in the profit and loss account, and there is no remaining prepaid income on the balance sheet. So the key point to remember: cash is received once, income is earned over time, and the prepaid income balance gradually reduces as the rent is earned.